September quarter results are drawing to a close with only a handful of companies left to reveal their report cards. The combined net profits of 42 Nifty 50 companies that have declared their results so far went up by 19.2% year-on-year and reached a record high of 1.12 trillion rupees in Q2 FY22. In comparison, the combined net sales of these companies were up 26.5% year-on-year, while their combined operating profits were up 11.2%. However, slow growth in operating profits compared to revenues indicates a decline in operating margins, and this has worried analysts. Before we get into that, let's go to Joseph Thomas, Head of Research at MK Wealth Management Services, to see how he assesses Q2 earnings.
Season is not over as yet. We may have a few more days of earnings updates, but overall it looks satisfactory. It also reflects the fact that economic recovery is on. Sales growth for Sensex had fallen by about 5% in Q2 of FY21, but Q2 of FY22 shows that it has risen by about 22%. Sales growth for Nifty had fallen by about 7.5% in Q2 of FY21, but it has now risen by about 34%. So sales growth has moved on expected lines, but EBITDA margins have come down in sharp contrast to what we had seen in Q1 and Q2 of FY20. Currently, we have a scenario where sales growth is improving, while there is margin contraction. But what is more important in this context is to see whether sales growth is accelerating further on the back of the strength of the economic recovery, and whether that translates into better pricing power in the hands of the corporates is something that we need to see.
As pointed out by Thomas, this earnings season was a hit on EBITDA margins, which was likely because of India Inc.'s inability to pass on increased input costs. Going forward, experts expect margin contraction to continue over the next few quarters as commodity inflation results in wage inflation.
And when we say inflation, we generally focus on commodity inflation, raw material inflation. There is a second wave of inflation which could emerge from this commodity inflation, that's the wage inflation. That may have a much longer impact on corporate earnings. As of now, corporates are facing some kind of labor shortages, and also their capex cycle is gradually picking up. These two factors coming in, and the wage inflation could gradually start picking up. That may have an adverse impact on earnings. Second is that as far as the rate of economic growth goes, it is likely to become stable to higher as we move on to the next few quarters. If growth becomes more intense, the pace of recovery becomes more intense, the pricing power of corporates will also improve.
Amit Gupta, who is a fund manager PMS at ICICI Securities, too believes consumer-related companies will continue to face headwinds as commodity-related inflation will remain sticky in the near future.
In quarter 2, we have seen that the company's margins because of this higher commodity prices has been hit. So the commodity user companies, I think going forward, there is some challenge because of this for them. Because commodity inflation is here to stay, I think. Even in the coming quarters, I think if you see the aluminum or steel prices, so somewhat the prices, are not expected to come down sharply. There may be consolidation possibly at the elevated levels, which is possible in these commodities. So companies, they have to adopt, they have to go for more cost optimization in order to, come out better going forward.
That said, all is not that bad for India Inc. Despite margin hit, the street has lauded companies that have managed to increase their market share.
Clearly happening despite the margins are hit. For example, take the case of Asian Paints. Asian Paints margins, gross margins declined by 10%. but their market share actually has been increasing continuously. So they are if you see the last whole year, financial year 21, and now these quarters, we have seen they have increased the share not only from the organized but also from the unorganized space. Similarly, from the fast moving electrical goods, we have seen some good results. Havels, for example, continuously on quarter basis, they have posted good numbers, and despite they have increased the prices in cables or in fans and all, their market share also has increased. So this is something that market is looking at, that this formalization of the economy, where the lower the spectrum companies are finding little tough, the business is flowing into the relatively better components of the sector where the market share is increasing now.
Against this backdrop, what is the earnings outlook for the second half of the current fiscal year?
Expectations for H2 of FY22 looks constructive, robust and positive. This is mainly the fact that economic growth is happening, and economic growth is quite broad-based. Last few years there has been an accent on avoiding mainly capex plays and also leveraged companies. But as of today, the leveraging has come down and companies are now in a position to borrow more and spend, and also the banking system is also in a position to lend more, with having got a fix on their asset quality issues. We expect both B2C and B2B segments to do very well. And after a gap of many years, it's expected that the government capex is going to be overtaken by private capex. We expect the near-term earnings to remain very good, and the medium-term outlook also looks quite.
For Amit Gupta, value-linked sectors like banks and capital goods are likely to do well, and he expects overall earnings to grow at a CAGR of 25% till FY24. On Friday, companies like Burger King, Deepak Fertilizers, Grasim Industries, Hindalco Industries and ONGC will declare their September quarter results. That apart, investors will also track industrial production data for September and retail inflation data for October, due to be released later today. Moreover, shares of Fino Payments Bank will also debut on the bourses today. Globally, inflation concerns, bond yield movement and oil price trajectory will guide the sentiment.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.